Hello and welcome to an all new episode of Perspective right here on the CryptoCast Network. This is the show, of course, where we interview authors about their latest articles about in the Bitcoin and crypto space. And we're super excited tonight to bring you guys Nik Bhatia. But before we get into that, let's share out the links here, guys. We really appreciate it if you could check out our site at cryptocast.network. There you'll find our YouTube links, Twitter, Instagram, iTunes and RSS. You'll, of course, be able to find the links to our audio feeds there within the iTunes and RSS if you guys prefer to listen instead of watch. And we have our merchandise on the site as well if you guys want to support the channel. And, of course, we are displaying our QR code at the bottom because this channel is run by, is funded by viewers like you. So we really appreciate all the tips and feedback and information. This is a journey that hopefully we can all take together. And we are still, of course, doing our Programming with Bitcoin.com workshop, an interactive 2-day workshop where we teach C# developers how to integrate Bitcoin into their applications. That is taught by both myself and the creator of the Bitcoin library, Nicolas Doyer. And we're actually trying to bring this around the country to try to get more and more developers talking about Bitcoin and integrating Bitcoin into their applications. So we're going to be going to Vegas in just a few days, September 1st, and then San Francisco, October 13th, and Seattle, Washington, November 3rd. So if you guys are in those areas, definitely check us out. We'd appreciate it. It's going to be a great time. We have the whole schedule lined up there on the site. And again, all you really need to know is C#. We're going to be teaching the fundamentals of Bitcoin to you and everything. So it should be a great time. So with that aside, let's go ahead and stop the screen share and introduce our guest tonight, Mr. Nik Bhatia. Nik, how you doing today?
I'm doing great, Vortex. Thank you for having me.
Yeah, man, I really appreciate you coming on the show. You like you say, we were talking before the show that I was probably one of the first person to, share out your articles, one of the first people. And I just think that that's great because this is really important. I think this information, this really is a next step on the evolutionary path of Bitcoin and Lightning. So, I'm really glad that you can that we have somebody like yourself to describe and outline these types of things for us. So I know that this is kind of new, like you are kind of, bridging a new frontier. We are trying to understand the financialization of the inevitable and financialization of Bitcoin. So maybe you can just start us off with why you decided to write these articles, because we're going to be talking about a couple of them, specifically the Bitcoin second layer, and then of course the time value of Bitcoin. So maybe you can just introduce yourself just a little bit briefly, and then tell us why you decided to write these articles.
Sure. So my day job is as an interest rate trader for a large asset manager in Los Angeles, and basically I'm trading treasury bonds and other interest rate derivatives on a daily basis. And global macroeconomics is my passion, and I love markets. And I got pretty deep into Bitcoin a couple years ago in 2016, and it was right around the time when the SegWit update had been proposed, and the Lightning Network white paper had just come out. And I started to read a lot about SegWit and Lightning Network, and somebody, I believe it was Andreas Antonopoulos, put out a video, an explainer video on Lightning Network, and he described the activity of routing and collecting fees as earning interest on your Bitcoin. And immediately I knew I had to dive into this because it was merging Bitcoin with interest rates, and I really wanted to explore this concept and see what this can do for the capital market in Bitcoin. And so I started to explore this topic, and after some writing and some thinking about it, I thought that maybe if we can earn interest in the Lightning Network, maybe we can use these interest rates to build a lending market that is derived from the Lightning Network itself. And so that's kind of how I started working on this stuff.
Awesome. Yeah, there's a lot of interesting things there. I mean, I really think that, like I said in the beginning, this is the next step in approaching Bitcoin as an actual capital market, Lightning Network together combined, this multi-layered, multifaceted approach to this decentralized money, this decentralized new asset class, this digital scarcity. So let's go ahead and start with the first article. Though this article isn't the one that you wrote first. You actually wrote this after this, but I think I wanted to reverse it because this was you actually wrote it as sort of a prelude, sort of a precursor to the next article. So let's go ahead and start with this. It is the name of the article is called the Bitcoin second layer, but what it really goes into is a lot about the first layer. And so maybe we can talk a little bit about that, about layered money, about the layered approach to understanding money, because money throughout time has always had multiple layers. And this we see this manifest also in networks and network security. We see that we have the Ethernet layer, right, that goes all the way up to the TCP/IP stack, and everything has to be layered almost when you're talking about scale. Right, when you're talking about trying to scale various networks, whatever it is, whether it's networks of physical items, whether it's network of digital items, whether it's people even, you have to have some type of layered approach. So I'll let you go into a little bit and describe, maybe because in the article you start out with gold's layers. So maybe you can start out a little bit about that, speaking about how gold has different layers.
Right. So the idea of earning interest on the Lightning Network was, how I really got into this. And that's why I wrote The Time Value of Bitcoin as my first article. But then what I wanted to do was take a step back and explain to people maybe that weren't as familiar with the Lightning Network, why, in fact, the Lightning Network is important, and try to debunk a couple of the criticisms of the Lightning Network that I had seen out there. And other people have done so, very well. What I'm doing here is presenting an analogy of gold. And I want to describe gold as a protocol stack, if you will, and compare that to Bitcoin. So I view the first layer of gold as raw gold nuggets that come out of the ground, when they're mined. And this is the raw form. It follows only one rule, and that's where it falls on the periodic table of elements. And going from there, the second layer can be viewed as, when you melt that gold down and make it into standardized weights and measures, coins and bars. It's still physical gold. It's still a bearer asset, but it is a second layer in the way that the first layer is not what you're using to transact with each other. We're not going to use gold nuggets that we take from the ground and transact with each other because there's no uniformity to the purity and the weights there. So we can look at coins and bars that are standardized as a second layer. Then onto the third layer is where you start to experience counterparty risk, and it's no longer a bearer asset, but actually a claim that you have with some other counterparty. So, for example, a bank taking your physical gold on deposit and then issuing a piece of paper that says, I owe you 1 ounce of gold. That's definitely no longer a bearer asset. It carries counterparty risk, but it is still gold and it can function as gold. And the parallel here to the Lightning Network is that Lightning Network, where you're using real Bitcoin, we can transact in the Lightning Network instantly, whereas on the base layer, we have to wait for confirmations on the blockchain, which can take time, up to an hour to get 6 confirmations, which is, commonly known as the best practice in terms of taking final settlement of your Bitcoin. So the third layer here is, where you start to take counterparty risk. And the fourth layer was just another example of how we can potentially look at gold certificates from different vaults, exchanged to some, central clearing party where all gold certificates across banks are considered like instruments, and that would make the speed of transactions even quicker with those fourth layer gold certificates. I present these layers of gold just to show people that money evolves in layers and different layers serve different functions. If you want final settlement of your gold, you're going to take the coins and bars as delivery and put that in your pocket, put that in under your mattress, or put that in your vault, wherever it is. But if you want to transact with that gold, let's say every single day, are you going to be carrying around that gold in your pocket every single day? Probably not. And that is how the gold capital market did evolve, where gold certificates started to increase the velocity of gold. And Lightning Network can definitely increase the velocity of Bitcoin. Now, the risks in Lightning Network and the degree of counterparty risk that you have in Lightning Network, it's going to be unique. It's going to be a little bit different than gold. In the Lightning Network, I do view that there is security risk and there's channel state risk, but I don't view that there's a direct counterparty default risk because nobody can default that Bitcoin to you. You are not you are still maintaining your private keys, right? And that is that's the game changer here in Lightning Network, and that's really what I based a lot of my work off of.
Yep. So having no, third party counter risk. This is one of the huge value props, for Bitcoin. And so that's really interesting. Of course, I never really, never really made the connection by to having an interest rate, using Lightning. But it is absolutely fascinating to talk about this. Now, these different layers. I wanted to bring this up because again, I think this is important for people to understand. Like you say, this is how money evolves. It's not, everything is not supposed to be on one layer, counter, to maybe what some of the BCH and Roger folks out there think. We absolutely need to have multiple layers. Now, it's also important to understand that each layer, beneath it, each layer uses the layer beneath it for consensus and security.
That's
So
right.
so layer 2, right? It's not quite as secure as layer 1, but it is still secure because it uses layer 1's security. It's tied, in fact, to layer 1's security. Now, like you say, we do increase risk though each layer that we go up, but it's important to know that each layer has its own function, its own reason for being. It's not like just decided that no, it's going to have multiple layers just to make things, more complicated, more complex. No, because a lot of people are like, oh, why do we need to add complexity with Lightning? And it's like, guys, it's actually not adding complexity. It's what we're doing is we're making it easier. We're adding rails, right? We're adding the ability to teleport Bitcoin from point A to point B instantly. Like that is a pretty amazing thing. And let's see, I guess maybe you just want to end this particular section out with the fact that the base layer is the most important layer because this is the layer that is used for financial settlement, right? This is how pretty much every single money layer works, specifically as you described it in gold. That first layer is for final and complete settlement. It's the higher layers, that facilitate, like you say, all the economic activity. That's where all the, like you said, that the increased velocity happened. You can just have so much more transaction throughput happening on these higher layers, and that's why they're there. That's why they're designed to be there. Now, of course, unfortunately, we've had a bunch of corruption with LIBOR and other different things, and with golds that unfortunately presented a lot more risk than I think people originally forecasted, especially with the amount of corruption that we see in the gold markets today. But with Bitcoin, I think that that's going to be a lot different because it is, physical settlement. Like you say, that there is no counterparty risk. Nobody can actually physically take away your Bitcoin. And I think a really important point you put in this article, maybe you can even comment on this, Nick, but you say, critics, they're often incorrectly identify a feature of Bitcoin as its slow speed, right? They often they try to say this is a bad thing. They say that the slow speed is a flaw. Maybe you can just comment a bit on that and how and why it's actually not a flaw at the base layer.
Yeah, so the final settlement is the key here. It all comes down to the blockchain and the proof of work that's required to take final settlement of Bitcoin. And think about going back to gold. Think about somebody that wants to transact in gold. Now, if you want somebody's paper certificate, that's fine for the time being. But if you really want to take final settlement of that gold, you're going to take that gold certificate, take it to the bank, and take the coin or the bar out of the bank and put that in your pocket. And so that's what the base layer of Bitcoin is. It's that final settlement. Now, if you want to use the Bitcoin at a much faster speed, that's what the Lightning Network is here for. So they really serve different functions. Obviously, the Lightning Network cannot function without the base layer. The base layer is everything. It is the innovation. And the Lightning Network is a way to transact that Bitcoin really just at a higher velocity. So the way I like to think of it is Lightning Network is an app on top of Bitcoin, and you can only participate in the Lightning Network if you bring real Bitcoin into it. And so everybody in the Lightning Network is already bringing real Bitcoin, and we know that because you have to broadcast a transaction to the base layer in order to open a channel in the Lightning Network. And that really is the fundamental security that we have in Lightning Network, where the Bitcoin that's circulating in the Lightning Network is real Bitcoin.
Absolutely. And again, guys, like you said, this is not the 10 minutes, the security, it's not a flaw, it is a feature because the intention of Bitcoin at the base layer is absolutely a censorship resistant scarce digital cash, not just, some kind of method of payment. It's not a payment network by default. We didn't need a new PayPal, guys. That's not why Bitcoin was created. Okay. And that's just a really important point. I want to put it there as well, because everybody is so concerned with transaction throughput today. Trying to think, I got BCH people, telling me we can't fit 5 billion people's worth of transactions on the Lightning Network yet. And it's like, yes, you kind of can't fit 5 billion people's worth of transactions on any crypto network right now. It is very, very early days, and we are still scaling this. So let me ask you this then real quick before we move on to the next part, Nick. What would you say to people that maybe say that Lightning might be an altcoin? I know it's kind of strange, but we sort of have to address some of this stuff because, again, to me, it's just so simple. It's hash lock time, cryptographically verified proofs that these channels are opening and closing on the Bitcoin network, which requires Bitcoin. Yes, it locks Bitcoin up, quote unquote, but again, it doesn't really lock it up. It holds it in place until you decide to move it, because it, like you said, requires real Bitcoin. So maybe you can just expand a little bit on that before and after that, maybe you can also talk a little bit about how these Lightning Network transactions being interpreted as actual financial agreements, like real smart contracts. In my opinion, the Bitcoin smart contract really is the only actual real working smart contract at scale, and specifically the only decentralized smart contract. So first, again, maybe comment on the altcoin argument, and then maybe a little bit about how Lightning really can be interpreted as these financial agreements.
Sure. So the altcoin comment, it's actually I try to think of it very simply. Bitcoin on the base layer is settled, while Lightning is unsettled. It's still Bitcoin, but it just hasn't reached final settlement yet. And anybody in the Lightning Network that wants to take final settlement, all they have to do is broadcast the correct state of that channel, and they can take final settlement of their Bitcoin onto the base layer. But yeah, I mean, it's definitely not an altcoin. You have to use real Bitcoin to participate in the Lightning Network. There is no supply. There is no artificial supply inflation there. It's just unsettled transactions. Basically, that's why we can do it so fast, because we don't have to wait for 10-minute blocks to take that, to know that Bitcoin is ours. We can take it unsettled, and when we're ready to, we can close it out and then take final settlement and wait for those confirmations on the base layer. And then to go to your question about financial agreements, yes, HTLCs are financial agreements. They are an agreement between two parties. They have the TL stands for time locked, and this is just basically your escrow component that has a start and an end to the channel. And so the way that we can view hash time lock contracts is as an agreement between two parties that has a specified expiry, right? And all financial agreements have an expiry, right? And so that's kind of the way that I think about it, where it's an agreement that has a countdown, and at the end of the countdown, the terms that you agreed to at the beginning are executed in an automatic way, because you both signed those that transaction at the beginning.
Awesome. Great explanation. I really couldn't agree more. I mean, that's exactly how I think even a developer would describe it. This is the escrow component. This is not an altcoin. This is real Bitcoin, temporarily locked up in an escrow that can be, even returned to you, right? If something goes wrong, like the channel will close and you will receive your Bitcoin based on what the channel says, right? So it's just really important for people to understand that Lightning is just the second layer approach. It is still very, very real Bitcoin, very real Bitcoin. And that's just what I wanted to get across there with that point. Okay, great. So let's get into a little bit more now of the reference rate. Now that we kind of understand layers, now that we understand the importance of Lightning and really what it is, let's maybe get into a little bit of the actual Lightning reference rate. So let's see, maybe you can go into a little bit about sort of how maybe you decided to how you discovered this, and then we can get into a little bit of what actually it is, and then we'll get into the components. So maybe a little bit about how you discovered this, and then let's get into actually what you're defining it as.
Sure. So, what I'm doing here is I'm just making an observation. So this observation did not come from me. Again, like I mentioned earlier, I believe Andreas Antonopoulos had a great video about this a couple years ago. But he's basically describing the activity of staking Bitcoin to the Lightning Network, earning fees as interest. And I completely agree with this because basically to calculate interest, you only need three things. You need your principal, which is how much money you started with. You need the income, which is the routing fees here in the Lightning Network. And you have time. And that's the time that it took you to do so, whether it's the time of your HTLCs or some other arbitrary um, time period that you're looking at. So the three components to calculate interest are already observable in the Lightning Network. We can see how much money we stake, we can see how many fees we earn, and we know the time that it takes to do so. And once we have these three components, we can calculate interest. So how we're going to calculate this is up for grabs. That's what I want to communicate with developers about and see, what's the best way that we can calculate this. Are we going to use block time? Are we going to use the time period of your HTLCs? Are we going to use some arbitrary time period? I'm not really sure yet. But the simple fact is we can already calculate interest. And in fact, I wrote an article about this where Alex Bosworth, one of the star developers in the Lightning Network right now, he put out a tweet where he was comparing fees that he earned versus another Lightning node. And I, kind of broke down and formulated my own calculation method there to show people, how we can calculate interest. From there, going to a reference rate is it's going to take a few more steps, and we can get into that. But I wanted to differentiate first that on an individual node basis, we can already calculate the interest that people are earning on their individual Lightning nodes. What we can do with those individual rates is what I call LNRR, and that is actually what I'm bringing to Bitcoin. There are so many brilliant people in Bitcoin, the devs and the financial people and the evangelists that I'm learning so much from them. I have, and I will continue to learn so much from them. But yeah, the unique thing that I'm bringing here is this idea of a Lightning Network reference rate, which is, let's call it a glorified average of all the individual Lightning node interest rates.
Awesome, awesome. So then let's see here. So you did say that you can calculate, basically because of these observable variables, right? Principal, cash flows, and time. So there's something we have this type of feature already in capital markets, right? So something like LIBOR. So maybe you can tell us, how do you think that maybe this is going to be safer than some of the way that we calculate these interests in this traditional capital markets?
Sure. So let's take LIBOR, for example. So LIBOR historically has been an interbank lending rate. It's basically the rate at which banks borrow. So you have a LIBOR panel of about a couple dozen banks, and what they do is every day they publish to each other their funding rates. That's the rate at which they borrowed in the open market, right? And so these couple dozen banks, they all borrow at different rates. Theoretically, they're pretty close to each other, and they publish them to each other. And then, the top couple are dropped, the bottom couple are dropped, and the rest of them are averaged. And that's what we get LIBOR. It's a daily fixing. It doesn't fluctuate throughout the day. It's just published once a day. And, that's the idea of LIBOR. So I think that LIBOR is actually a great model for how we can develop LNRR, but I definitely don't want to confuse people into thinking that I believe this should be a centralized, closed-door process. It's actually quite the opposite. In Bitcoin, we want everything to be as open and as transparent as possible. So I like LIBOR because it's an example of how a reference rate has existed in the traditional financial system, where people just or banks are just publishing their rate to each other, and then it's averaged. And I think Lightning Network reference rate can follow a similar pattern where individual Lightning nodes are earning interest and they publish that rate to each other, and then we can see some sort of average and use that as a reference rate for other financial transactions.
So hopefully we can cryptographically prove the rates that we're actually sending out via our nodes. And so I think that's going to be pretty important, because everything that has to do with borrowing now, everything that has to do with calculating interest now, always brings risk. And a whole lot of risk, like not even like a little bit of risk, but it seems, especially with what we've seen in the past, to bring a lot of risk. So then let me ask you the next question, maybe before we move on to talking about Lightning banks and such. What kind of rates are we seeing right now? Like what kind of Lightning reference rates are we seeing? Because obviously we know that LIBOR, underpins like $350 trillion in derivatives, but just what kind of rates are we seeing in these early days of Lightning now, when there's only a couple thousand nodes?
Yeah, so I don't have a ton of data points. I do have a couple data points that I wrote about in that article about Alex Bosworth and the tweet that he put out there. So I don't want to make too much of the rates that I've calculated. Alex himself wanted me to point out to people that the rate that he was earning is not indicative of anything in the future. It just happened to be the rate that he earned during that 1 week and that he published to us. But what we did see is that he earned 40 basis points on an annualized basis. So that's 0.4% that he made if you were to extrapolate that 1 week into a full year. The other node that he put that rate out, that he put the fees and the principal out for, that person was earning 1/2 of a basis point. So that's 0.005%. And so Alex Bosworth was making an interest rate 80 times, 80x that of the person he was comparing himself to. So that just goes to show you the huge disparity in these early days of what people are earning. And I do think that the rate that people are going to earn on their Lightning node is going to be highly correlated to their technical skill here in the beginning of Lightning Network. And that means, how are you positioning yourself in the routing network? How is your connectivity to large nodes? What fees are you charging? Are you charging competitive fees, or are you charging too much where people are not going to use your channel? And many other factors here. So it is going to function a lot differently than the current financial system that we see with banks and with lending rates. Lightning Network is this really novel idea, and I don't actually know how the rates are going to play out. I do have a couple data points for you guys, but really I think it's too early to say what the individual Lightning node rates are going to be, and eventually what the Lightning Network reference rate will be. It's just too early to say. I do know that I do expect the fees to be very low on a percentage basis, just because I've seen people buying their Lightning stickers from the Blockstream store and paying 1 Satoshi. So it's not really like there's a lot of money to be made right now. But again, that can change, and we'll just have to wait and see how the network forms and how this plays out.
Yeah, very interesting to know that we're talking many times, many tens of times more than traditional rates that you can actually earn. But like you say, this is early days. I suspect that will probably go down a little bit, but we know that node operators are incentivized to keep their fees low. We know this because the software itself, of course, is extremely simple to run, free, open source. It doesn't require a whole lot of resources. That's the big thing, is it just doesn't require all these resources. Like, for example, something like mining. It's just endless computations. So I think that for the most part, the fees will be low. Maybe you can. I just thought of a question off the top of my head here. How about this? Maybe you can answer this, because here's another criticism of Lightning Network that I don't think it's really a criticism, but some people do. What do you think about Lightning Network taking fees away from miners, because again, we're talking about how Lightning Network node is incentivized for you to keep your fees low. So my personal take is that this will just allow Bitcoin to blow up many orders of magnitude, and so that the miners can basically have a smaller chunk of a bigger pie, or a chunk of a teensy tiny little pie, compared to what Bitcoin could be without Lightning. So maybe you can comment on that real quick, of what you think about possibly one of the criticisms of miners of Lightning Network taking away fees from miners.
I think that the two fee markets go hand in hand, and that they're not, one doesn't take away from the other. They serve different functions, and they are occurring on different layers. So if you want to use the base layer to take final settlement of Bitcoin, you're going to have to pay a miner a fee to include that transaction in the block, and that's what you're paying for. In the Lightning Network, if you want to send money to somebody, you're going to pay a routing fee to a node that happens to be between you and your final destination, and that's the service that you're paying for. So I really don't see that one is taking away from the other. They just serve different functions, and actually over time, I hope that each transaction that gets posted to the base layer, hopefully many of those transactions are actually the closing of a Lightning channel that had hundreds or thousands of transactions in the interim. So I think that could be a really cool way to see the whole network unfold going forward, where maybe that closing of that channel is very valuable to the person that was operating in the Lightning Network, and at that point they're willing to pay the miner and the miner his fee to settle that, to get that final settlement on the Bitcoin. So they really just serve different functions.
Yeah, I couldn't agree more, because I also think that people misunderstand the evolution of Lightning Network and how it's going to play out. And really, in my opinion, how it's going to play out is that channels at one point won't even really need to be closed that often. I mean, we're going to have like these really big nodes, these really big liquidity channels, right? That people are going to be going through, and a lot of these, most of these will really not need to be closed. They'll just be auto opened. They'll be with multipath. We can just go through, send one transaction through multiple channels, and there just really won't be a need to close channels all that often. So that's like a big part, because people are talking about how nobody's going to open and close channels all day long with high Bitcoin fees and things like that. And it's like, look, guys, there's really not going to be that high of fees with SegWit and further optimizations to the network, things like batching. All of these things are going to make sure that as Bitcoin evolves, the fees stay relatively low. And we're going to have, we're going to have learning curves. We're going to have swings, right? Where we have like last year where we're like, oops, the fees are freaking $100. Maybe people should start activating SegWit that was put on the network 6 months ago. Maybe people should start batching their transactions, and using the network more efficiently. And so I think that's what we're going to see play out with that. And again, like you say, different fees for different layers. That's just really, really, really important. It's just like you say, like they complement each other. It's the same. These fees won't overlap or be counterproductive to each other for the same reason that multiple layers don't, because they each have their own individual.
Right.
They're each own individual function, their purpose for being there, that complements every other layer above and below them.
And I just want to touch on batching real quick, because
yes,
this is so important. This is the market reacting to the situation. So as you said, fees were skyrocketing, and blocks were full. The backlog was enormous. The mempool was enormous. And what started to happen in the months later? People started batching their transactions and using the blocks more efficiently. And so this is a market reaction to a hurdle. And this is the beautiful thing about Bitcoin. It's all open source, and there's nobody controlling it. So the market is going to react. And how are the Lightning fees going to evolve? We don't know, but I can tell you one thing: it's going to be market driven, right? And how are people going to close those channels and decide to take final settlement of their Bitcoin? I'm not sure, but the market will determine when that person wants to take final settlement, and they will pay the miner his fee, and they will take final settlement of their Bitcoin. So the free market aspect to Bitcoin and Lightning Network is incredibly important, and it's fascinating to me. And I think anybody that is a markets person or has an Austrian economics background, or even wants to see minimal intervention from the state in in markets and in money in general, I think this Bitcoin in general is very exciting to people like that.
Absolutely. And we did have a question in the chat talking about how, where can we find merchants with channels? But look, there's a couple websites where you can Google and find actual, channels that are specific for merchants and things like that. But guys, look, I want to stress this one more time. By the time Lightning Network is ready for the end user, you will not have to worry about channels. If you look at any discussion relating to Lightning Network, you'll find that they all talk about abstracting away channels eventually, making it farther and farther, pushing it farther away in the UX, eventually just making it disappear completely. So I just don't want people that are learning about Lightning to get too wrapped up in channels. It's just not something that the end user is going to have to worry about any more than they're going to have to worry about HTTP routing. You just type in an address and it goes there. You don't have to worry about which IP addresses it's connecting to, how it's being routed, all that crazy stuff, right? So I think that the Lightning Network will be very similar this way, where it's going to act just like your regular wallet. You send a transaction to somebody and it's there. So whether that means that there'll be default channels that get open that everybody kind of trusts, because like OpenDNS, we have some DNS servers that we trust that are more open than centralized. Maybe there'll be that kind. I don't know how it's going to play out, but it will play out to where channels will just simply not need to be worried about by the end user. Now, I think I want to get into now to the Lightning and Bitcoin banks section part of your article. So we were talking, you do talk about how it's going to take maybe a bunch of these Lightning banks to actually provide enough liquidity to actually establish a real Lightning Network reference rate. And before we have you talk about that, I just want to say that and sometimes I get heat about this, but I try to tell people that, look, Bitcoin is probably not going to remove all the banks, right? What Bitcoin does is remove the need for central banks. It doesn't actually remove the need for local retail banks. We still need to be able to create loans. People still want their hands held. We still want a third party to hold our keys in case our house burns down or whatever. And some people do, some people don't. Some people just want to have their own setup. But the average person wants their hand held, right? They want to know what's going on and they want to be able to talk to somebody. And so I think that there's still going to be Bitcoin banks that are going to be around, and there's going to be these Bitcoin banks that provide these Bitcoin services. There's going to be several services. So just like we saw with the internet, where the telephone companies all turned into internet service providers, I believe that we're going to see all these banks, at least for sure, these local retail banks, turn into Bitcoin service providers. And really, the need for central banks won't really be there. Maybe you can comment on that too. Like, do you see before we get into like the Lightning banks, do you see Bitcoin removing the need for central banks, or do we still need some type of central bank to for various financial reasons besides creating the money? Because I'm actually okay with central banks and and banks like in general still existing, as long as we take away their main most powerful issue, their main most powerful feature, their biggest superpower, which of course is the ability to create money out of thin air. So let me ask you, do you still see central banks existing in a world with Lightning reference rate and Lightning banks and Bitcoin banks?
Well, central banks issue domestic currencies, right? The dollar is issued by the Federal Reserve. The euro is issued by the European Central Bank, et cetera, et cetera. Bitcoin is another currency. It's a digital scarce cash, and it's going to function as its own denomination going into the future. Now, whether Bitcoin replaces all fiat in the future or not, I don't really think I don't necessarily.
Maybe not replace.
Okay.
Yeah, but like because central banks have specific roles, I think, in addition, right, to just creating money. So how what do they look like in a world with Lightning banks and Bitcoin banks?
Well, I think it really comes down to the money supply. So this might not be exactly what you're asking here, but it Bitcoin's money supply helps to define it, right? And the Federal Reserve's monetary policy helps to define their currency, which is the dollar. And in a world where currencies can compete with each other, people will gravitate to the currency that they identify as having the best monetary policy, or the monetary policy that fits their need the best. So really, I think that central banks across the world are going to have their own monetary policy, and maybe they'll have to change their behavior to react to Bitcoin in the future. Maybe not. I still think that's a long way off. But yeah, like you were saying, Bitcoin doesn't need a central bank because it has an algorithmic monetary policy and money supply schedule going into the future. But you will still need bank-like actors in Bitcoin that are liquidity providers and custodial services, etc. So those are the things really that banks or Bitcoin banks per se can provide. But definitely, there is no central bank in Bitcoin. We have a supply schedule that was determined at the beginning of the protocol. And the consensus has been since then that monetary policy and that money supply schedule is pretty much set in stone into the future.
So we do have another question from the chat before we move on. Let's ask this from Matt Smith. Will banks create another fiat and peg it to Bitcoin? Do you think that central banks, because this would be a central bank thing that they would, more than a retail local bank, right? That could possibly do something like that. Do you think this is a pretty speculative question because it's super far out, assuming that all sorts of things like that, that Bitcoin could take over central banks and things like that. So what is your answer to that? Will do you think banks will create another fiat on top of Bitcoin?
Well, think of it like this. Any two currencies have an exchange rate with each other, right? And so we can observe the BTC USD exchange rate in the market. There are plenty of exchanges where we could see that data. Well, if there's another currency, let's call it XYZ, you have an XYZ BTC pair, and maybe it's the XYZ issuer's intent for that exchange rate to be one to one. Whether it stays at 1 to 1, the market will determine that. Maybe the issuer is fraudulent and that exchange rate is not going to trade at 1 to 1 in the future. Or maybe they're a great actor and they don't artificially inflate the supply and they actually keep Bitcoin on reserve and they issue currency XYZ at a 1 to 1 ratio. And then in theory, yeah, that could trade at 1 to 1 to Bitcoin. So again, the market is going to determine that. We can already see exchange rates with Bitcoin and other currencies. And if there's another currency created in the future, that exchange rate will exist in the market. And whether it trades at 1 to 1 on a go forward basis is anybody's guess.
Absolutely. And hey, let's be very clear here, guys. Fiat is losing trust all over the world. Right now, in every country, people are rethinking fiat because we're seeing various horrible fiat currencies that we knew weren't super great, like the lira, right, the Turkish lira, and Venezuelan bolivar, and various other currencies. We've seen just completely dive, and it's not going to slow down, right? This is going to accelerate over the next few years as we continue to enter these bubbles of these money printing. These money printing bubbles. So I just think that, if they tried to do something like that, good luck getting trust, right? Good luck getting the market to value your currency anywhere near Bitcoin. Like, good luck trying to get a 1 to 1 peg on that. Someone's going to take the other side of the bet on that one. And I can assure you, probably going to win Bitcoin. So let's move on to then a little bit more detail about Lightning Bank specifically and as they relate to the Lightning Network reference rate. Maybe you can describe a little bit more. I'll pull up the article on that section, but maybe you can describe a little bit more about what you're talking about with that section with the Lightning Banks.
Sure. So it's not actually too complicated. It's basically another way of describing a node operator who is starting that node with the purpose of providing liquidity to the network. So they're going to be node operators that, it's their intent to facilitate consumer merchant transactions. And there are going to be other nodes that, are serving different functions. But they're going to be nodes that it's their function to provide liquidity. What they're going to do is try to open the most channels with the highest balances that have the best connectivity to the rest of the network. And that's basically what we were talking about in terms of technical know-how and skill. There are ways that you can earn maximum potential fees in the Lightning Network. going forward. And I think that those types of actors will be called lightning banks. So, it still could be, a single person on their laptop with a full node and a lightning node, and somebody that has enough Bitcoin to open balance to open channels, or it could actually be a bank itself that has a lot of capital and is going to come in and open those channels and try to position themselves as a central point in the network. Now, again, let's not make too much out of this word central point, because in the Lightning Network, it's your choice whether you want to use a certain path or not. And so if you see a central entity, a big bad bank that you don't want to give your routing fees, you could just route around them. And maybe you'll have to pay a little bit more, maybe not, but really it's your choice. And eventually, yeah, we might have software that's going to do all this automatically, but still the control is still in your hands. It's your private keys. And if you want to enter your transaction in the command line and make sure that the Bitcoin that you're sending does not go through a big bad bank that you want to avoid, that is your right to do so. And it's a free market, so we'll see how it evolves. Now, once these lightning banks or these liquidity providers start earning interest, I believe that large liquidity providers, hopefully they can cryptographically prove the rate that they're making, publish it to each other, and we can average these rates to form what I call LNRR, or Lightning Network Reference Rate, and that can be a reference rate for other loans that take place off-chain. So that's where we get into the difference between counterparty risk and not counterparty risk. And in the traditional financial system, the way that I like to make this analogy is to talk about U.S. Treasuries, where U.S. Treasuries are the perceived lowest risk asset in the U.S. dollar financial system, and other entities that are borrowing are doing so at a spread to U.S. Treasuries. So whatever the Treasury is borrowing at, a company will have to borrow at that rate plus a credit spread. So I see that that's a potential model for LNRR, where LNRR is the lowest perceived risk rate that you can earn. I'm sorry. LNRR is the rate that you can receive on the lowest possible risk investment in Bitcoin, because you're still maintaining control of your private keys. Even though you're taking some hot wallet risk and some security risk there, it still is going to be potentially the lowest risk thing that you can do outside of cold storage. And that should theoretically be at a rate that's lower than somebody else that wants to borrow, where you actually have to broadcast your transaction to the blockchain and send your Bitcoin away. There's no recourse there. You have full exposure to that counterparty. That counterparty can default to you, and you can lose your Bitcoin entirely. And so I think that interest rate should be higher than what you can earn on the Lightning Network.
Okay, great. So once these Lightning, once we have these banks, these Lightning Network banks, essentially, then we can have this Lightning Network reference rate, so that we can then understand what to borrow and understand what we can do with capital markets above that. So let me ask you then, Nick, what is the next step then once we have Lightning Network reference rate? What is the next thing you think that we'd have to build in order to really kind of have this financialization of Bitcoin?
So I'm not sure that we have to build it, because I do believe that it already exists, and that's Bitcoin borrowing in the open market. So there are direct lending platforms, and there are exchanges that offer lending of Bitcoin so that people can go out and short Bitcoin on that exchange. And so there are already observable interest rates that are Bitcoin denominated today. And so, what we'll do at that point, where if we have a Lightning Network reference rate, is we'll start to compare the relative interest rates of direct lending, where there's real counterparty risk, and Lightning Network reference rate, where there is no, let's say, no direct default risk that you have. You have malicious actor risk and channel state risk and hot wallet risk, but you don't have that default risk there. And we can start to assess the relative value between the two. And that's really that's really what capital markets are all about. It's all about relative value and relative risk and relative reward, right? If you're going to lend your money to the US government, you expect to get your money back at the end of that term. If you lend it to some random startup with no track record, you are less you are expecting to get that money less so than you are from if you were to lend it to the US government. So that's really all capital markets are about. And that's what LNRR is about. It's striking a new point on Bitcoin's risk spectrum where cold storage Bitcoin is not going to have any return, and it's in theory going to be actually negative because you're going to have storage costs, and if you want to move that Bitcoin, you're going to have to pay a miner a fee. So there's definitely no income with cold storage. There can be income on the Lightning Network, and there can be even more income if you take counterparty risk and actually lend your Bitcoin out to somebody and send that Bitcoin and broadcast that transaction. And you have to trust that counterparty that they're going to pay you back in the future. So it's really about measuring the different levels of risk and the different levels of reward associated with each level of risk.
So how will this affect like exchanges? So for example, like BitMEX and other exchanges, you can actually lend out your Bitcoin, right? So people can use it to for liquidity to short and long the market. So do you think that this Lightning Network reference rate would affect that? Or do you think the exchanges and what rates they set will affect the Lightning reference rate?
Well, both will occur independent of each other. And I think what's going to be relevant is the spread. So BitMEX lending rate will trade at a spread to LNRR. And then, the next exchange is going to trade at a spread to LNRR. And then we can actually look at BitMEX spread and another exchange spread and compare the exchanges and think, okay, now we can make a conclusion on which exchange is more or less creditworthy than the next, right? So again, it comes back to relative value and relative risk and relative reward. It's not that one rate will drive the other, or that the exchange lending rates are going to drive Lightning Network reference rate. The rates are going to happen independently of each other, and it's more about how we can view all these rates holistically in a full risk spectrum, and just make some conclusions about each different entity in the capital market.
Well, awesome, Nick. Listen, it's been great talking to you, man. We've been almost going an hour, so let me just close it out with something you wrote here. You say that Bitcoin staked to Lightning is the most unique income-producing asset in all of monetary history. Income with zero counterparty risk. The historical implications of this on capital markets are tremendous. So maybe you could just comment on that real quick, and then I think we can close it out.
Well, there's never been a situation, to my knowledge, where you can lend money on a short-term basis and have no worry whatsoever that the person you're lending to is not going to default to you. And that really is the unique thing here, okay? We're not talking about the fact that Lightning Network has no risk. You are definitely taking that Bitcoin and putting it in a hot wallet environment and putting yourself subjective to theft or hack or whatnot. So I definitely don't want to, glorify Lightning Network as a risk-free environment. It's not. But you still maintain control of your private keys, and in the current system, if somebody tries to steal your Bitcoin, not only can you broadcast that justice transaction, or the anti-cheat transaction as it's called, and get your Bitcoin back, but you can actually sweep all the Bitcoin from the channel to yourself as kind of a punishment. So the way that works, and the way that I view it, is it really is unique, and I think that it's something that I'm glad that people are talking about now. And I definitely would love to get in touch with more developers to see, if we can start to measure this, if we can start to agree on a calculation method for individual Lightning nodes and how we can calculate their interest rate. And then maybe, once we start to agree on a calculation method on the individual node level, we can come together and publish it to each other and get a sense of what the Lightning Network reference rate is.
Absolutely. Great points. I wanted to close it out on that, but now I got a thought of one final thing, just one final point I just want to make. You were talking about how, because there is a bit of another, there's another criticism about Lightning Network about how, the nodes are going to centralized and we're going to, oh no, we're going to have a node we have to route around. There's nothing we can do, Nick. But of course, as you described, the note by very nature of the Lightning Network, we can route around any node we want. Like if we don't want to have a specific node in our route, we can change it. And I just want people to realize that this is why nodes cannot centralize for two reasons. One, because you control the route, and two, because the node software is free, so it's incentivized to keep fees low. So there's no node that can just be like, you know what, I'm going to take all the liquidity and now I'm going to start charging extra super big fees because we can. That situation is just not possible with the Lightning Network. Is that right, Nick? Nick? Oh, we might have lost Nick. He's frozen. Uh, hopefully we didn't lose him. But if we did, I just wanted to make that point, guys, because I think that's really important. We have Nick back in now. He's frozen. He was frozen. But I just asked you real quick, Nick. I was just describing about the ability to route around nodes and the fear that nodes are going to be centralized. And maybe you can just comment on that, because I try to tell everybody that, look, you can route around the nodes and the nodes are forced to have low fees. So there's just no way to centralize around like scooping up all the liquidity and then charging exorbitant fees.
Yeah, I mean, it's like you described. You can route around it. It's a free market, and you have control of your private keys, and you're not forced to do anything in Bitcoin if you don't want to. And I always like to remember what happened during the UASF, and remind everybody that we are in control of Bitcoin collectively, and if we want something to happen, you know we can push that view onto the network and see if people agree with us. And really what happened in the UASF there is that people are like, we want SegWit. We know SegWit is going to help Bitcoin in the long term, and we're not going to stand for not getting SegWit updated to the protocol. And so I always remember UASF to remind people that the good actors in Bitcoin have proven that they can win in the past, and I do believe that they will continue to in the future. I wrote an article about ETFs. ETFs are scary to some people because of centralization, but you don't have to use an ETF. And what we can do is we can even force the ETFs to publish their public keys so that we can see their holdings are real. So there are so many things that the users can do to make sure that Bitcoin is what they want. We all can use Bitcoin different ways. Some people hodl, some people trade it. Some people are going to start Lightning nodes and put all their money into providing liquidity. We all get to choose what we want. No one, every layer above the base layer is opt-in. You don't have to use it. And that's what I have to
great.
say.
That's a great point. Always remember, guys, the UASF hashtag. Never forget the UASF, the user activated soft fork, the event that proved users are in charge of the network, not miners, not corporations, not nation states, not any large entity like that. It is up to you, the people who run their full nodes, to determine what the rules are of Bitcoin. So with that, Nick, I think we can close it out, man. I really appreciate the time. Really appreciate everybody in the chat, everybody viewing. If you guys didn't see this live, we do hope, of course, that you can join us again live. This will be available. I try to do a perspective every week, at least a couple every week, so you guys can definitely find that here. And of course, we also have the other show, Deciphered, where we interview software developers and hardware developers, and of course, our famous Bitcoin news show. That's on every Sunday at noon Pacific. However, we're going to skip this Sunday because, of course, we have the programmingwithbitcoin.com workshop this Saturday and Sunday. And again, that is, of course, a course just like Jimmy's, except instead of teaching protocol developers to work on Bitcoin, we teach application developers to work with Bitcoin. And that's what it's all about, guys, getting more and more people, specifically developers, of course, into Bitcoin so we can help build out this ecosystem. And I just really appreciate, again, everybody joining. If you guys are new to the channel, please hit the subscribe button. If you guys like what you see, hit the thumbs up. We really appreciate it. And until next time, guys, we will see you again. Just keep talking Bitcoin. See you guys later. Bye-bye.